Welcome back to Switzer. My next guest is from Supervised Investments Australia, which looks at stocks that are, to most people's eyes, in the too hard basket. So let's just see what they're finding in the too hard basket, and let's just see why they like these types of stocks. Joining me is Mitch Taylor, who is Portfolio Manager of the Australian Micro Cap Fund. Great to meet you, mate.
Nice to see you.
So tell us a little bit about the history of this company.
So Supervised Investments was founded in 2007. At the time, this fund that we're here to talk about today was established. It's been running since then, and it's done quite well, this fund. It's up 40% over the last 12 months, 20% over the last...
40% over the last 12 months, that's a terrific return.
Yeah, we've managed to weather a few of the more spectacular collapses in the, I guess, the micro-cap space by, as you alluded to, sticking to stocks in what we call the too hard basket. So what we do is we look for, we believe that the conventional valuation approach is correct, and the conventional or valuation philosophy is that the value of a share or the value of a security is approximately equal to the present value of its expected future cash flows. So with that in mind, we don't see any point in chasing companies or buying stocks where everybody expects the same future outcome, everybody expects the same tailwind to continue or the same revenue growth and earnings growth to continue. In those situations, we by definition think you can only really earn your cost of capital. So what we do is we hunt situations where there's uncertainty, where there's a degree of disagreement amongst market participants. Maybe there's a litigation outstanding. Maybe it's the stock's in a sector that's well and truly out of favour, or maybe it's a serial disappointer.
So, but how do you ensure against your opinion being wrong? Like outstanding litigation, you never know what's going to happen.
Yeah.
How do you insure against that?
Well, it's very, very difficult. And we run a relatively concentrated portfolio with 20 to 30 stocks. So we spend a lot of time, understanding the company. So once we see one of these uncertainty situations start to take place, we jump in there and we'll spend weeks researching a given company, not a sector, a company. And we ask ourselves three questions. The first question, and by far the most important question, is do we think our unit holders' capital is safe under the vast majority of potential scenarios? So a lot of things can happen. And if that's hard, and often at the moment we're looking at many that don't pass that test. If we tick that box, we go to number two, and number two is do we think that the stock can generate abnormal returns under a majority of future scenarios? And if we think that, we go to number three. And number three is probably what makes us a bit different to a lot of contrarian investors out there, because so far I've essentially explained a contrarian investment policy. But what makes us different is we have to have an identifiable catalyst to ensure that our investment thesis can be realised.
To take it to the next level.
Yeah, to make people's expectations change, and hopefully it becomes a boring stock where everybody expects the same thing to happen.
Okay. So give us an example of a company that fits the bill currently.
Sure. Well, a company that we invested in about 4 months ago is called Hillgrove Resources. The ticker's HGO. We didn't actually invest in the stock. We invested in a unique structure. There was called a secured convertible note with attaching options. So we own debt, but we can double down into equity. Hillgrove Resources is an Australian copper producer, and it has been an absolute disaster. It's nearing the end of its mine life, and we think it's finally the outlook's good for current shareholders, but it has been a woeful company. It has.
Well, and the copper price hasn't helped, has it?
Well, no, it hasn't. I mean, the company's market cap dropped from about $230 million in 2010 to $10 million.
God.
In 2016, but along the way they raised about 150 million of extra, of new fresh equity.
Really?
So that's serious money that's been,
Yeah. So some people believed in their future story.
Yeah. So once upon a time, people expected success. So we, late last year, it became apparent that the company was searching for only $5 million. The market cap was less than 10, so it was well and truly in the too hard basket. There'd been 3 CEOs in a couple of years. The copper price was at 7-year lows. The the grades had not been as everybody had expected, and obviously the share price had gone down. So when we saw that they needed an extra $5 million to get them through to what they called the honeypot, we began investigating. So we found that the situation was that the company had invested $60 million on a giant cutback of an existing open pit. So, in plain English, that means that they have dug a deeper hole, or they've dug a bigger hole and spent $60 million moving all of this dirt. They needed to spend another $5 million to get through to June this year.
Yeah.
And then if their mine plan was correct, and if copper price stayed where it was at 7-year lows, we did our research, and we thought that they could generate $100 million of cash in 4 years and pay it all out. Right. So we're investing at a $20 million market cap effectively. So it's 5 times upside, and wow, that sounds too good to be true. So we checked and we checked and we checked, and it seemed legitimate. Yeah. They changed the independent expert who audited the mining reserve, so you never know, but we thought it was, odds were on that it is there. Yeah. And then we thought, well, what happens if the copper price reverts to its 5-year average? And great, if that happens, the upside is another $50 million.
It's an easy investment for you.
Well, in hindsight, it's worked out. But I guess what I wanted to bring is the worst case scenario, which is what we focused on first, and we spent probably the vast majority of our time on this scenario, and that was, will we get our money back? And in this case, we thought we would, because they had tangible assets in the form of a processing plant that could be sold for scrap, and we'd still get our money back. So it's those sort of asymmetric.
It's everyone's given up. Stuff, isn't it? All right. So how has the share price gone for Hillgrove?
Well, it's gone up. It's so we're in at 3 cents. So just to put it into perspective, with that $100 million of cash is about 15 plus cents per share, and we still think that the copper price has rallied. So if everything goes to plan, they'll generate north of 16, and it's 16 cents, but they're at 7 cents. So it could double. Yeah.
So from my point of view, people listen to this think, well, this is a company, if I want to add some alpha to a core holding of very safe stocks, you guys are an interesting addition, and I'm sure some people would be interested to do some homework on you as well. All right, mate, great. Thanks for coming on the show. If people want to know more, what's the website?
www.supervisedinvestments.com.
All right, mate, fantastic.
Thanks very much.
Nice to meet you.
Nice to meet you.
That's Mitch Taylor.